Every dollar you earn, every paycheck you deposit, every mortgage payment you make, none of it works the way you think it does. You believe your bank holds your money. You believe when you get a loan, the bank gives you someone else's savings. You believe the money in your account actually exists. All three of those beliefs are wrong, and the system depends on you never realizing it. This isn't conspiracy, it's accounting. The money in circulation, more than 90% of it, was never printed by any government. It was typed into existence by commercial banks, created from nothing but a promise. And the moment you understand how this works, you'll see why inflation never stops, why debt keeps growing, and why the system cannot afford for you to be free of it. Welcome to the financial system. Control the money, control the history. And remember, simple is never easy. To understand how we arrived here, we need to go back, not to modern banks, but to medieval goldsmiths in the cities of Europe. These men weren't bankers. They were craftsmen with one valuable asset: secure vaults. Wealthy merchants, fearing theft, began leaving their gold with goldsmiths for safekeeping. In return, the goldsmith issued a receipt, a slip of paper, promising that the bearer could return and reclaim their gold. Over time, something remarkable happened. People stopped collecting their gold. They traded the receipts instead. After all, the paper was lighter, safer, and represented the same value. The goldsmith's note became, in effect, money, and that's when the trick was born. The goldsmiths noticed that on any given day, only a fraction of depositors actually showed up to withdraw. If they held 1,000 gold coins, perhaps 20 or 30 might be demanded in a week. The rest just sat there. So they got clever. They began issuing more receipts than the gold they held. If they had 1,000 coins in the vault, they would write 2,000 receipts, lending the extra claims at interest. As long as everyone didn't come for their gold at once, no one noticed. The goldsmith was profiting from wealth that didn't exist. Money was being created from thin air. This wasn't a minor trick, it was a revolution. The moment people accepted paper claims as equal to gold, money creation was unshackled from physical reality. What had been fraud became finance. Governments saw the opportunity immediately. In 1694, the Bank of England was founded, not to protect ordinary citizens, but to solve a crisis for the crown. England was drowning in war debts. The bank's founders proposed a solution. They would lend the government money it didn't have, funded by issuing notes far beyond their gold reserves. In exchange, they would collect interest, guaranteed by taxes extracted from the British people. That moment established the template still used today. Banks create money through lending. Governments guarantee the system through taxation. And the public carries the cost through inflation and debt. The United States adopted the same model. Early American banks issued notes redeemable in gold, but they quickly realized they could print far more notes than they could ever cover. Periodically, the illusion cracked. Bank runs erupted when depositors rushed to withdraw and discovered the money wasn't there. Banks collapsed by the hundreds. Yet instead of abolishing the system, governments doubled down. They created central banks to backstop the illusion, to ensure that even when the money didn't exist, the public would keep believing it did. Now let's break down exactly how this works in the modern era, because the mechanism has evolved and it's more powerful than ever. Imagine you walk into a bank and deposit $100. You assume that money sits safely in your account. In reality, the bank is required to keep only a tiny fraction, historically 10%. It lends out the rest. Someone borrows your $90 to buy supplies. The seller deposits that $90 into another bank. That bank keeps $9, lends $81. The cycle continues. By the end, your original $100 has multiplied into nearly $1,000 circulating in the economy. But here's the catch. Only the first 10 actually exists as cash. The other 900? Debt. Every new dollar created through this system is born as someone's obligation to pay it back, with interest. And here's what most people don't know. That 10% reserve requirement, it no longer exists. In March 2020, the Federal Reserve reduced the reserve requirement to zero. Banks are no longer required to hold a single dollar against the deposits they take. The neat multiplier has been removed. Banks can now create money limited only by their capital ratios and their willingness to lend. So how does it actually happen? When you apply for a mortgage, the bank doesn't take cash from a vault and hand it to you. It doesn't transfer someone else's savings. It simply types numbers into your account. That money didn't exist before you signed the loan. It was created the moment you agreed to pay it back. The bank then records your promise to repay as an asset on its books. Your debt becomes their wealth. And the new money you now hold, it enters the economy, where it circulates, gets deposited, and fuels yet more lending. This is why more than 90% of the money in circulation is not central bank money, not cash printed by the government, but bank money created by commercial banks through the act of lending. Think about what this means. The money in your checking account isn't the same as the paper in your wallet. It's a digital promise created from debt, and the system only survives as long as borrowers keep borrowing and confidence holds. Now consider the unavoidable consequences of this design. First, inflation. Because banks continuously multiply money through credit, the supply of dollars expands faster than the supply of goods and services. Each dollar becomes worth less over time. This isn't a bug in the system, it's the feature. Inflation is baked into the design because debt requires more money to service, and more money erodes the value of what came before. Second, perpetual debt. Since money enters existence as a loan, there is always more debt in the system than money to repay it. The interest owed on every dollar created exceeds the principal. Someone somewhere must always default, refinance, or borrow more just to keep the game going. The balance sheet never closes. Third, concentration of power. Banks collect interest on money they never had. Governments tap this system to finance wars, welfare, and bailouts without raising taxes directly. And the wealthy, who hold hard assets like real estate and stocks, watch their wealth grow as inflation pushes asset prices higher. Meanwhile, workers see their wages buy less every year. This machine has cracked before. In 1929, banks had lent wildly beyond their reserves, fueling a stock market bubble. When panic hit, depositors rushed to withdraw. The money wasn't there. Banks collapsed by the thousands. The Great Depression followed, not from a lack of resources, but from a collapse of confidence in promises that could never be kept. The same happened in 2008. Banks had multiplied credit through mortgage-backed securities, complex instruments that disguised the old Goldsmith trick in modern packaging. When defaults spread, the system nearly imploded. Governments and central banks responded by pumping trillions into the system, not to protect ordinary people, but to preserve the illusion. They bail out the trick, because without it, the modern economy cannot function. Today, the scale is global. In the United States, reserve requirements are gone. In Europe, the United Kingdom, Canada, and Australia, they had already become symbolic. The entire Western financial system now runs on capital rules written in Basel, Switzerland, by unelected technocrats who determine how much risk banks can take and therefore how much money can be created. Here is the uncomfortable truth you must accept. The system cannot afford for you to be debt-free. If every household paid off their loans tomorrow, the money supply would collapse. Banks would have nothing to lend. Economies would freeze. Your participation, your willingness to borrow, to spend, to believe the digits in your account are real, is the fuel that keeps this machine running. You are not a saver in this system. You are collateral. So what do you take from this? Not panic, awareness. First, understand that money is not wealth. Real wealth is not numbers on a screen. It's land, skills, resources, relationships, and independence. Assets that hold value when paper promises dissolve. Second, recognize that debt is not neutral. Every loan you take makes you a participant in a system designed to favor lenders, governments, and asset holders at your expense. Third, know that inflation is not an accident. It is the silent tax that has operated since the Goldsmiths first scribbled false receipts. Every year, you are asked to run faster just to stay in the same place. Building real wealth, things that survive outside the cycle of inflation and debt, is the only path to financial freedom. The lesson isn't paranoia, it's clarity. If your money is born as someone else's debt, your freedom depends on stepping outside that machine. History doesn't repeat, but it rhymes. The goldsmiths of medieval Europe,
The bank panics of the 19th century, the crashes of 1929 and 2008, all echoes of the same story. A trick that multiplies promises beyond reality, and a public that believes until belief becomes impossible. The next time you look at your bank balance, remember, most of it exists only as entries in a ledger, born from debt, sustained by confidence, and vulnerable to the oldest danger in finance, the moment when everyone asks for their money at once.
Understand the trick, and you can begin to protect yourself from it. Ignore it, and you remain another player in a game where the house always wins. If this gave you a new perspective, hit subscribe. Its financial system and history leaves clues. I show you where the money leads.